So we've got the Rand assuming a new title, worst performer in the basket of 20 emerging market currencies. And this, as we've seen the unit fall back lower against the greenback. What are you making of this extreme deterioration we're seeing in the currency's position?
Well, the Rand's come back a little bit over the weekend. We had Rand a lot weaker last week. It was trading closer to that 840 level. Slightly better on the day as the Mexican as well as the Brazilian currencies have come back. Slightly better risk on book. We're seeing the gold rally back above 1620. So, you know, the market still remained jittery. Unfortunately, we didn't get any resolution this weekend as the G20 met with regards to the debt crisis in Europe, etc. We're waiting for some announcements around that EFSF package as we look for the debt outcome with regards to Greece, and then obviously the remainder of the week a couple of data pointers with you know, the CPI coming out of Germany and housing starts out of the United States. So you know what, sentiment still remains relatively negative. You know, the markets have rallied hard with regards to risk-off trades. We're seeing some of that pullback. You've seen the US Treasuries come back a little bit, but overall the markets still remain relatively risk adverse.
Persistent debt concerns in the eurozone, that's the dominant theme right now. Are we simply going to have to sit back and wait for tenable solutions to be derived on that end before we see any sustained reprieve?
I think we're seeing, you know, you're looking at the moment, we're kind of relying on the IMF to come through with, you know, the IMF and the ECB to support the eurozone. Ultimately, they have made statements that really are in support of what's happening in the eurozone with regards to keeping that as a united entity and not letting Greek default. That being said, though, we're waiting for Finland, Slovakia and the German vote this week to see whether or not that EFSF package will be pushed through. And then, you know, we're starting to reach crunch time because ultimately that 8 billion euros has to go into the Greek economy to support that economy. So, you know, you're still seeing the credit default spreads widen. You're still seeing support in the bond markets from the ECB, Italian bonds, Portuguese bonds and Spanish bonds. So whilst that remains, it still means that the eurozone remains under pressure and there is concern around the debt crisis within that zone. And then as well as the fact that, you know, both sides of the ocean, being the United States and the eurozone, you know, the growth outlook in those regions has been downgraded and relatively will be very, very slow in the uptake, certainly as we go into 2012.
Of course, you touched on risk aversion being at play right now. How much risk aversion and how much a result of pulling back of liquidity? Because last week it was a case more so of the latter that seemed to be driving the weakness on the local unit.
You know, there's a lot of concern in the markets at the moment with regards to liquidity, specifically offshore liquidity. You're seeing the likes of European banks coming under pressure. You're seeing less and less cross-border lending to one another, and you're seeing a blowout in terms of the overnight repo rates, etc. So those kind of concerns mean that there is some pullback or repatriation of funds back into balance sheets. You've seen the gold, and that's really being where the big moves happened, is, you know, that quality buy of gold has been sold off in order to pork up balance sheets. And really the concern is, from a South African perspective, although we offer a yield opportunity, ultimately cash is king and balance sheet does matter. So we do still have a massive risk that that can continue, and if that does continue, unfortunately it will erode further value in the Rand and obviously in our local bond markets.
With that, just looking at the local, at the crosses, we've got the dollar standing as a clear benefactor. Still just a case though of choosing the less of two evils at this stage, because the US not without its problems, you know, but maybe looking or perceived to be a little bit better off than the eurozone territories right now.
Well, that's it. You know, the thing is that ultimately the US has always been viewed as a safe haven. And, you know, I think more and more conversations happening about what safe havens really look like. Is the United States really a safe haven? And that's something that the market is contemplating, as well as what we've seen with regards to Japan, and then what you saw happening in the SMB, where they ultimately support their currency because ulterior safe havens have been so badly blown out of the water that they have to protect their currency. So, you know, there's a large debacle in terms of, one, who can take up that kind of debt or who can take up that kind of cash flow, the United States being obviously the biggest benefactor of that, as well as the fact that a relative risk play is coming off book as the market remains extremely uncertain in this very, very dire growth outlook. So the play-off between the United States and the Eurozone, based on the fact that the Eurozone's headlines around the debt contagion issues, unfortunately put it on the back foot for now.
We've got data coming through locally this week. Just how much attention do you see the market paying this way? Because there's just so much globally for markets to consider.
Well, I think we've seen the MPC behind us, so that has been the main driver. I mean, we did expect to see the global growth outlook definitely impact our MPC decision. I think there is still a lot of concern around global growth, and that's really where all eyes will be, with regards to seeing how that sort of growth is, the deterioration of the growth, how it's impacted economies. It is a little bit backward looking. So when you're looking at data like CPI out of Germany, etc., unfortunately that is over the last, month or the last quarter. And unfortunately, that's something that slowly will play itself through the market. Business confidence, you can expect deterioration. Durable goods numbers out of the US, you can also expect some form of pressure. But ultimately, it boils down to the fact that in South Africa, we are going to get a knock-on effect of what's happening globally. So we really do care about what the data is printing, especially in the eurozone right now.
Very quickly, Brigid, on the bond market side of things, government bonds weaker, nudging yields higher, and some saying that this is with the softer currency likely to cap any gains the market had anticipated, on the back of bargain hunting after the heavy sell-off we've seen in the local debt market. Do you share that view in terms of the kind of trade we're anticipating on that front?
I do indeed. I think that we've kind of seen the bottom on bonds. I think that the bond market at the moment, a lot of the driver was offshore demand, purely because of the fact that we had that yield carry, which is still relative, but with, as I said before, with the liquidity issues, I think that the bond market remains under pressure, as well as the fact that our treasury is still issuing into that longer end, which means that our bond curve is relatively steep, despite the dovish outlook. So for now, tomorrow we've got our auction again, 209s and 207s. We expect further pressure on the curve. Currently sitting at about 152 basis points, 186, 157. We expect that to persist prior to the auction. Bonds to remain soft, but following the tone of the rand. So the rand strengthened slightly. We have seen a bit of a pullback, slight strengthening on bonds as we watch the rand tone. We expect to see the bond market basing at these levels whilst the market absorbs whether or not liquidity is back on book and whether or not you will see foreign inflows into the market. And you're not seeing significant foreign offshore flows into our bond market. So it's keeping it at around 7% on that 157.